But so let's talk about the economic reality of this, because the political reality is you and I are never going to get to the bottom of this in the time we have. But the economic reality, how do you take what you've observed on the political scene, you take what you've looked in terms of asset prices and valuations, and you take what you've seen from the Fed and the interest rate cycle, how do you apply that to your investment philosophy right now? Has it changed anything? Has it made you adjust anything?
I think that, Grant, the most important decision for an investor at a point in time with regard to the intermediate term, by which I mean not tomorrow and not 30 years, but the next 2 to 5 years, the most important decision to make today is whether to invest aggressively or defensively. And it's not all one or all the other, but how do you mix the two? You know, an investor like me faces 2 risks every day. The obvious risk that everybody knows about is the risk of losing money. The other risk, which is a little more subtle, is the risk of missing opportunity. And so what most people say is, well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities, so I'm going to do something that compromises on the two. And each person's positioning vis-a-vis the 2 risks should be different based on their circumstances. But still, then that's the first question. And then the second question is, you figure out your normal risk position, and you look at today, and you say, well, today, should I be worrying more than usual about losing money or more than usual about missing opportunity? And you know, I just think that the world is an uncertain place, and the things we're talking about contribute to the uncertainty. And so today I would emphasize avoiding the loss of money a little higher than usual vis-a-vis avoiding the risk of missing opportunity.
Everywhere you look across the financial landscape, there's a series of successful and importantly pragmatic investors who are coming out and issuing what the headline writers call stark warnings or dire warnings. Seth Klarman being the most recent, perhaps, during the Davos thing recently. That I'm always interested that cacophony of voices that gets louder and louder and more respected by the day doesn't seem to change behavior at all. We seem to be in this period where, to your point, that fear of missing out is being re-weight adjusted by the smart investors, the guys who are always early, and yet the retail investors are wiping their brows and saying, well, December's over, Cramer said the market's going to go up, we should investigate the dip on Christmas Eve, everything's good again. Do you, when you look at the way average retail investors think about this, do you really want to find a way to reach out to them and say, listen, you need to think about it like this, you're not thinking about this correctly?
It's a tough one, Grant, because you know, I always imagine, you know, the movies that are made for the teenagers. And over here, sitting on their shoulder, you have the angel saying, don't do it, it's not prudent, you know, you'll regret it in the morning. And over here you have the devil saying, do it, it'll be fun. And the devil wins.
Every time.
And then that's why we have the movies.
Right.
But in the investment business, you know, you have prudence and history and knowledge of cycles and consciousness of the risks. And over here, the devil says, do it, you'll get rich. And, you know, wishful thinking, the desire to get rich is really dominant, and the fear of missing out together. And so we saw in the fourth quarter an incredible swing of psychology from positive to negative, but then back. And most of the damage has been made up. You know, most people don't invest in the long term. They're just trying to bet on what the market's going to do. The retail that you described, but also many professionals,
yes,
because they're afraid to be cautious and miss a good month, because they could lose business. It kind of goes back maybe to your first question, which is that most people are afraid to be wrong. And since the market goes up most of the time, being wrong consists of being out, which means most people are afraid to be out. And so their nature doesn't permit them to get out until
it's too late.
Until the crisis is upon us.
Yeah. So you talk about the volatility we saw in December, which is the first such volatility. We had a brief breakout a little while ago that got squashed quite quickly, but this is the first we've seen 500 and 800 point moves down in the Dow, which has come as a surprise to a lot of people. But do you think something has changed? Do you think what we saw in December is an early indication that we are moving into whether it's a pause phase and the market's going to find its new course, or we've reached the top and maybe we're going to bumble around here for a while before going lower?
One of my favorite quotes is from Einstein, who said something like, "I don't think about the future, it'll come soon enough." I don't try to guess what's going to happen. I just try to make good fundamental investments. And they tend to take care of themselves either soon or later. But, what you had was a crazy swing of psychology. One of my favorite memos was in February of 16. Remember, the market got off to a terrible start. And I wrote a memo called On the Couch, because I think every once in a while the market needs a trip to the shrink. And I said in there that in real life, things tend to fluctuate between pretty good and not so hot. But in the market, people act as if they go from flawless to hopeless. Yeah. And that's what happened in October. My new book came out on October 2nd, and I can tell you that the mood was quite good. And, in the months and years, couple of years leading up to October 2nd, the main comment I got from people was, well, we know it can't keep going on well forever, but we can't think of anything that'll make it stop.
Right.
And that was true up to then. And then on October 4th, the market decided to go down. And it went down for the next 80 days in one of the worst declines that's been seen in a long time. We had, I think, the worst December in history, if I'm not mistaken. So what changed? And my next memo may be on the subject, because I've been storing up thoughts. But fundamentally, not much changed. I mean, what was it that made the market start going down on October 4th? Well, they said, the 10-year just hit 3.25. But of course, it was expected, rates were expected to rise. Oil was weak. Well, I don't think that's really of great fundamental importance, because it's actually good for society when the price of energy goes down. Well, there may be a trade war with China, but that you could see coming for 9 or 12 months. So nothing really changed except for the mood. And I think the mood is absolutely unpredictable, so I don't even think about that. Fortunately, I don't make my business that way.
It's interesting because that hearing you say that makes me realize that's exactly what most people do. It's all about mood. They have it completely flipped around. They gauge sentiment. They chase momentum. Yeah. And to your point, it's not just retail investors. It's a lot of professionals. For some of them, against their better judgment. But we all have to try and manage risk. To me, first of all, I've been a trader my entire life. So for me, the first thing is always the risk. It's not the opportunity. I always look at the risk and think, okay, once I'm comfortable with the risk, then how is the best way to play the opportunity? Mm. Is there a time when you shift the way you think about making those longer term investments? Do you have to, is it fundamental investments, fundamental practices behind them that are constant? Or do you find that when you get to certain points in the cycles that you follow so closely, you have to shift the way you assess risk and opportunity?
Well, remember what I said, aggressive, defensive.
Yeah.
So sometimes.
So it's just that.
Yeah, sometimes. But it's often a bottom-up thing. See, because it's not like, well, you find a bunch of investments and sometimes you decide to go heavy and sometimes you decide to go light. What it is that sometimes you find a lot of great investments and they tell you that this is the time to load up the boat. And sometimes you can't find any bargains, and they tell you this is a time to be defensive. So it's not an independent decision, you see. Now, a lot of people make that decision top down. They look at the macro, they look at the number, technical, and all the trading numbers and all those things. And I look at the mood of the environment. I look at how people are acting and thinking and talking, and that tells me also whether I should be aggressive or defensive, as I described in 05-06. But it also comes through in the investments. You find things that you say, well, I think that's half what it should be. I'm going to load up the boat. So you turn aggressive. But for the most part, you don't get many of those opportunities when the market is galloping along and everybody's optimistic and risk aversion has gone out the window. So it's all of a piece. But I do think that it's desirable at the extremes to alter your behavior. Now, I was working on the book, and I gave some chapters to my son to read, who works on our family investments. And I told him, I think my market calls have been about right. And he said, yeah, Dad, that's because you did it 5 times in 50 years.
Right.
The point is, and I didn't even stop to think about it that much, but of course I thought about it in this later days. But when you are at an extreme high or an extreme low, the logic is compelling and the probability of being right is high. But when you do it in between, the market's 5% overvalued, 2% undervalued, 10% overvalued, the logic is not compelling, and the probability that you're right is modest at best. So 5 times in 50 years, once a decade. Yeah. And that's what we tend to get. We tend to get one of these and one of these a decade, but these are not always extreme. And so you can't make a career out of playing the extremes of the cycle, but they can inform what you do. And you can modify your behavior in between, but you shouldn't count on being right.
It's the perfect way to wrap this up. Howard, thank you so much for doing this. I've been waiting to talk to you for such a long time, and it's been everything I hoped for and more. So thank you for being so generous with your time.
Pleasure for me too, Grant. You made me think about some things I hadn't thought about.
Well, that's a feather in my cap. I take that proudly. Thank you.